Hi there, this is Helen Tarrant again from Uplift. Here with our whole team. Wow, it's massive. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and this is going to be a three-part series. So this is about commercial property mistakes, pitfalls, and I guess disasters in some ways. We're going to talk a little bit about what to look for when you buy commercial properties, right? And I'm going to start off with the first one, where we're going to talk about the three major things that you need to look out for when you're buying set and forget property. So the three mistakes and pitfalls people fall into when they buy set and forget type of properties, right? And the second one, I'm going to talk about Uplift, the biggest mistakes people make when they buy Uplift properties, right? And because what I find is when people buy Uplift properties, typically they forget a few things or they have very good wishful thinking. And what happens with that is they end up paying more, or they don't get the returns on the other side, they can't flip it. Right, so that's number two, and it's a video on its own. And then finally, I want to show you what happens when you don't do your due diligence, things come back and bite you in the ass, or when you do the takeover period, or when you do your own stuff, a takeover period, it isn't effectively managed. And then, of course, ultimately, you have lots of things that you have to fix up. So, lots to cover. Make sure you join me for all three parts, right? All three parts. All three parts. So, video today, video next Tuesday, and the one after, so I can cover off all for you what it is. So let's get started. Number one, set and forget properties. And one thing that people do is they buy the wrong yield in the wrong area. Wrong yield in the wrong area. And I know during the pandemic that we have seen some crazy yield. We've seen places like this Gold Coast go to 4.5%, right? 4.5%. We've seen the Sunshine Coast compress in 2 years from 7% to 5.5% and keep going down. Now they're probably at 5 or early 5s, right? We've also seen areas like a Mackay, like a Gladstone go to 7% when they traditionally are 9%, and we've seen Rockhampton go to a 6%, right? I've seen industrial. Yes, they're industrial. Yes, you can't buy industrial potentially in Gold Coast or Sunshine Coast at 6% during the pandemic, but does that mean you pay 6 or 6.3% in somewhere like Rockhampton? My answer is, if you're my client, no. But obviously, lots of people have bought, and if they have, they really need to rethink that strategy, because what happened is now, when the market corrects itself in regional, it corrects a lot harder. And for most people who are their first-time investors, they actually don't have a clue what happens to regional properties when it corrects itself. They think that it happens like metro properties. Once it corrects itself, it will take a hit, kind of like residential, go down. When the interest rates plateaus, or when the market picks itself back up and there's confidence, the yield will go down again, or the value will go up again, and everybody is happy. That does not happen in regional. When things correct itself in regional, it goes sideways for a long time. It goes sideways, and it means that then the market actually goes back up and sideways. So a 6% yielding property in Rocky will correct itself back to 7 or maybe 7.5%, and it could stay there for literally 5 years, 10 years, right? Because before it started going down, an area like Rockhampton traditionally was a 9% town. It had been 9% town for decades. And that's what you got to watch out for, right? Yes, it will correct itself. Maybe Rockhampton will never be a 9% town, but it may get back to 7.5%. They get back to 8%. But what does that mean? It means that if you have bought in at 6.5%, you're going to be in negative territory and negative equity for a while to come. And that means that you literally cannot buy again, and your cash flow is probably going to be negative for a long time. And the fact that you're actually stuck in that property, just like if you bought in a mining town, for a long time, right? So that is the pitfall, right? So make sure you're buying the correct yield in the correct market. And even if you're thinking that I can't get this type of property that I want, like an industrial for 6% or industrial for 7% in the area I want, change the type of property you buy, right? Buy a retail instead, buy an office space instead, and you may end up with a higher a property with a higher yield because it's not the favorite at the moment. So the favor is obviously industrial, but if you're not buying industrial at the moment, you can potentially get a higher yield, a different type of properties. Again, this is all part of expert advice as well. So that is that. But the thing is, if it did come back on contract price at the time and you didn't know better and it was your first property and the yield was low and it came back on time and contract price, literally, there's nothing much you can do about it except to ride the waves, right? Now you've already settled, you've got to ride the waves, do the best you can. And so be it, right? Now, if you've done that, look, the only thing I can do is I can potentially look at some upsides for you, see if we can get some more rents. And if that can happen, we can probably change to bring the value back up and get you into the next property, or for you to actually sell it to get into a better, more secure property back in Metro. So that's the remedy. Number 2 thing you need to look at is people often look at a property and they don't check out all of the information about break leases, incentives, any obligations that the vendor has, that they had and that passed on to you as the new purchaser. So incentives are usually paid out as settlement. Sometimes incentives are not paid out in settlement because it was missed, and all that vendors have said up front, and this happens in Metro properties, no, I'm not going to pay you out the incentive, and you got to account for that in terms of your return as well. What are all the rent-free periods and things like that. But not only that, sometimes there's buried incentives or break lease clauses, and you think maybe that won't happen. Maybe there won't be a break lease clause. Maybe the tenant, because it's an NDIS government or a government funded tenant, or potentially or even a very big organization, there will be no break lease happening. But let me tell you, it does happen. It happens to medical, it happens to government funded tenants, and it happens to large corporations, right? They make a decision. I've had properties where I used to have Rivers in Singleton. They made a decision corporate wise that they were going to come out of regional, and they basically I had a 5-year lease. They pulled the lease and offered us a 3 months compensation, which for us, we fought on that, but that's another story for another time. But so that this way, at least you know that these things can happen, right? And you got to make sure you get risk money for that, right? If you don't get risk money for that, you're an idiot, or the fact that you haven't accounted for it means that you actually get a bit of a suffering in the background, right? Because that means that you get some lost rent. And also, if there was that break lease clause, one of the things I do is make sure I put money aside to make sure I can re-tenant that property. And that money aside may be 3 months, 6 months plus outgoings, and for me, and plus marketing, so that I could get the next tenant. So I'll put that aside when I get the property. And hopefully, if I bought the property, or if the property's on the market for, say, 6%, then I would probably hopefully get it for 6.5%. Then it allows me to put the money aside in case that happens. If it doesn't happen, great. If it happens, then at least I'm covered for it. So that's definitely something to keep in mind when you're looking at incentives and things that do break lease clauses, because these things do happen and you've got to have a contingency plan. A risk is only a risk when you don't have a contingency plan. When you have a contingency plan, it no longer becomes risk, it becomes manageable. And it's important to have managed risks, because all investments carry risks, but managed risks, it becomes more important, and it becomes easier to get into the next deal because you've got a plan in place. So I mean, those are just a few things to look out for, and just one of a few things to look out for when you're looking at commercial properties. You've got the yield as well as the cash flow. But like I keep on saying, especially in markets that change really, really fast, yield is not the only thing to chase. If you chase it and you don't make it 3-dimensional, this is where things starts to become problematic, and this is where things start to become where you're overpaying or for the property, right? Everyone don't care if they're underpaid, but they don't want to overpay, right? So that's number one thing. The other thing to follow on for set and forget is really your lease terms, break lease clauses, and anything to do with the leases, right? You're buying the property with a lease with a tenant in there. So obviously from time to time, you're going to have issues with the tenant. It's not always a given that your tenant is going to perform afterwards, right? And if your tenants don't perform afterwards, then it's kind of like, well, luck of the draw, right? Some tenant will go bust within 3 months, 2 years, 5 years, depending on how long your lease is, right? There's not much else you can do about it. However, one of the things that you can think about is that what can you do with this property to safeguard it, right? So there's layers and layers of safeguarding and risks, right? If you bought a property that is really maybe slightly too large, so let's just say that you bought the property and it has potentially 400 square meters or 600 square meters, and really it's too hard to rent out on its own, and you have to be realistic about this. When you're doing DD, you've got to make sure that you've got a strategy in place, right? Do you break that up into smaller properties, regardless of whether it's warehouse or office space or retail? Do you break that up into smaller properties, or do you try to rent them out as a whole, or do you then sell it to owner occupiers? What is your back end strategy, right? And this is something you got to think about as well. So that is the most important thing, is most people trip up because they don't know what happens when the lease breaks and the tenant leaves, and it does happen, right? Break lease clauses, people think that does not happen, or break lease clauses, people think that there's a very low chance of it happening. Does happen, and it can sometimes be purely that the signs were on the wall, and so when you did an inspection, let's say you went and did an inspection and you didn't find the people were there, or that during COVID the place was too big, you always got to look at your exit strategies and what do you have in place, right? And that's really, really, really important. And we look at that as part of our DD. But that's one of the mistakes people do, is they get a large warehouse, retail, office space, they get it with a tenant, the tenant goes bust or something happens to the tenant, and then they just want to tenant as is. You can't tenant as is. You got to spend some money, whether that for some people might be 20, 30,000, for some people that's 200K. But if you don't spend the money, eventually your vacancies will end up eating up the money anyway. So let's just not worry about it. Let's go and spend the money up front and get it done, right? So, and get the tenant in, and then you can start recuperating some of those costs as well. So that's the number 2 mistake that people make, is that they don't have a contingency plan. They gloss over the break lease clauses. If I saw a break lease clause, I'll certainly be asking for a higher yield for my risk money. And I'll be putting some money aside to work out how long it will take for me to re-tenant, right? These are some of the things, strategies you work on during your due diligence period as well. And number 3, the third thing that people stuff up on set and forget properties, is that they purely focus on that they want a location or the particular tenant or the particular type of property, right? And that can actually trip them up, because sometimes you're not as flexible when you go, I just want a medical tenant, and because I think it's secure. I want a childcare tenant. I want a, let's just say, I want a trade tenant. But the property becomes so stuck with that tenancy that once that tenant moves out, they literally cannot repurpose it, and it stays vacant for a long time. Now, I had a good example. I had a property today. I did an inspection this morning, right? And it was interesting. It used to be a vet. The vet moved out, and they've been trying to sell it since January last year. Now, we're in August the following year, right? So this property has been on the market vacant for 18 months. If you're the owner of that property, then you got to think, well, I will either try to lease it up, or I need to do some capital works to sell it, or I'm going to sell it to an owner occupier for a cheap price, because I'm just not going to be ready to put in the works, right? And someone would have paid a heavy price to buy a vet, because they think the vets are forever, but vets can move out too, right? And they probably thought the vet was going to renew their options, and when they didn't, they've now ended up with a year's vacancy or more, right? So don't get so specific with your properties to the point where, yes, you get so fixated by the type of tenant that you want because you think they're going to get security, but ultimately they move out and you end up with literally no security, right? Whereas you have a bit of flexibility in the type of property that you get. So it could be a vet today, it could be a childcare tomorrow, it could be a dentist, could be a spa, could be any of those things tomorrow, today, someone else. That kind of flexibility is actually more of a safeguard for you, right, than being really specific with your tenancies. So really, those are the 3 things that people stuff up on your set and forget type of properties. So remember those 3. Number 1, rent is too high and they've bought at a lower yield, and they in areas where they shouldn't have. So when the market rents itself, their property literally has no value, and it's negative equity, and it goes sideways, right? Number 2, they buy with a property that has break lease clauses or incentives or anything in the property. They didn't do their sufficient due diligence. When it happens, they don't know how to repurpose the property. They didn't have any backup plans for it, and what ends up happening is that they leave it vacant for a long time, right? And it can't be re-tenanted. And then thirdly, they buy a property that they specifically wanted that type of tenant, a trade tenant, a specifically trade tenant, a retail tenant or, you know, a big brand name tenant. McDonald's is very hard to repurpose, right? So is like a drive-through coffee place if you don't actually have other things behind it, right? If you look at, you know, your typical drive-throughs become a Macca's or KFC, and they're great backup. So if you've got something that is a drive-through that you can convert to them, that's great. Or if they have other components added to it, is great. Or add itself as a retail, it's very hard to repurpose. Childcare is very hard to repurpose. Even vets and large medical centers, very hard to repurpose, right? But you get so entrenched that's what you want. When the tenant actually leaves, it becomes much harder. So that's the third thing. So watch out for those three things as you're looking for set and forget properties. And again, if you want to know what are the pitfalls on specific properties, specific tenants, drop me a line, or, you know, reach out to me, helentarrant.com, Unicorn Commercial Property. My email's below. Don't forget to order my book, because it's got heaps of these strategies, plus what to look out for, what to do, what not to do, because ultimately it's all about finding the right properties, but having a backup strategy for your long-term goals, just in case something happens. Because we know in life, never does anything actually works out exactly how you plan. Because if they did, we wouldn't have had the pandemic or the GFC, right? Or the right interest rate rises. So these things happen. So what happens next is you got to make sure you have contingency plans and you watch out for those three things. So tune in for my next video where I'm going to talk about uplift properties and the pitfalls that people have with uplift properties. Following that on with another video on compliance and people who stuffed up in, you know, the takeover of the property, and then the compliance issues and what comes back to bite them afterwards. All right. In the meantime, reach out to us. Get on a strategy session, join one of our boot camps, whatever you do, get educated, because it's really important to ensure the security and the safety of your commercial property investment. Until next time, hit the bell, subscribe, see you in the next video. Bye for now.